Some companies need 40 cents of working capital to generate $1 of revenue. Others need just 5 cents. That gap tells you more about operational quality than most financial ratios, and academic research links it directly to future stock returns. Working capital is the difference between current assets and current liabilities. On the asset side, cash, accounts receivable, inventory. On the liability side, accounts payable, short-term debt, accrued expenses. But the raw number alone doesn't tell you much. A company sitting on $5 billion of working capital could be bloated or lean. It depends entirely on how much revenue it generates. What matters is the efficiency ratio, current assets minus current liabilities divided by revenue. Think of it this way. For every $1 of revenue, how much working capital does the business hold? 5 cents means lean. 40 cents means far more cash stuck in receivables and inventory. The lower the number, the tighter the operation. Richard Sloan published a landmark study in 1996. He split earnings into two parts, the cash portion and the accrual portion. The accrual component comes from changes in working capital accounts like receivables, inventory, and payables. His finding was clear. High accrual companies fell behind. Their reported earnings far exceeded actual cash coming in. Low accrual companies pulled ahead. Their earnings tracked cash closely. The gap ran to roughly 10 percentage points per year from 1962 to 1991. Working capital efficiency connects directly to this. A company with bloated working capital relative to revenue has high accruals by definition. It's reporting earnings that aren't backed by proportional cash flows. A 2004 follow-up study found that the spread between lean and bloated balance sheets was roughly 10% per year. Assets growing faster than the underlying business justifies is a warning sign the market consistently misprices. The real-world spread is dramatic. Apple has negative working capital, collecting from customers through carriers and retail faster than it pays its own suppliers. That's operational excellence at scale. Typical manufacturers sit at 25 to 35%, with raw materials in warehouses for weeks, finished goods waiting for shipment, and customers paying on terms of 60 to 90 days. That gap in operational quality predicts future returns. Let's screen for the leanest operators in the market. One SQL query ranks every company above $500 million by working capital efficiency, from the tightest operations to the most bloated. Let's screen for the leanest operators in the market. One SQL query ranks every company above $500 million by working capital efficiency, from the tightest operations to the most bloated. We join balance sheet data to income statement data for the same fiscal period, then compute the efficiency ratio. The core calculation is current assets minus current liabilities divided by revenue. A result of 0.044 means the company needs just 4.5 cents of working capital per $1 of revenue. A result of 0.089 means nearly 9 cents. Lower is more efficient. The join matches balance sheet data to income statement data for the same company and the same fiscal period. This ensures working capital and revenue come from the same reporting date, so we are comparing apples to apples. We filter for positive revenue because zero or negative revenue makes the ratio meaningless. We also filter for positive working capital. Negative working capital, where current liabilities exceed current assets, can signal operational excellence like Apple or financial stress. This screen focuses on the positive side and handles that distinction separately. The $500 million market cap floor keeps data quality reasonable and ensures the companies are tradable for most portfolios. We sort ascending so the most capital-efficient companies appear first. In the results, Booking Holdings shows up at 0.044, Moody's at 0.051, Costco at 0.00, MasterCard at 0.073, and Intuit at 0.089. You will notice an immediate sector skew. Technology, services, and subscription businesses dominate the efficient end because they collect revenue upfront and carry no physical inventory. That is structural efficiency baked into the business model. The most interesting tier for investors is companies between 5 and 15 cents, because when a capital-intensive business operates in that range, it signals real operational skill rather than just a favorable business model. Low working capital can mean efficiency or distress, and the raw screen can't tell the difference. 3 filters separate genuine leanness from deterioration. The first is a profitability gate, return on equity above 8% and operating margin above 10%. This filters out companies that look lean because they're declining. A company stretching supplier payments while its core business deteriorates shows up as efficient in the raw numbers, but it's actually in trouble. Profitability confirms the low working capital comes from strength. The second is revenue growth. Current revenue has to exceed the prior year. This eliminates shrinking businesses where working capital falls because sales fell faster than the balance sheet could adjust. If revenue is declining, low working capital isn't efficiency. It's a side effect of contraction. The third is an efficiency cap at 50% of revenue. This removes capital-heavy outliers and focuses the screen on genuinely lean operators. Anything above 50% is typical for heavy manufacturing or distribution businesses where the working capital level reflects the nature of the industry rather than management quality. This strategy has blind spots that persist even with quality filters layered on top. There is no sector context in the raw comparison. Software at 3 cents and manufacturing at 3 cents tell completely different stories. The software company is normal for its business model. The manufacturer is exceptional. A raw cross-sector screen misses this distinction entirely, and the results implicitly overweight asset-light industries, where low working capital is the default rather than a sign of quality. The signal has its sharpest discriminating power when you compare within sectors, not across them. The screen captures a single snapshot with no direction. A company at 10 cents that was at 5 cents last year is getting worse, not better. A company at 15 cents that was at 25 cents last year is improving rapidly. Direction matters just as much as the current level, and one fiscal period of data doesn't show direction. Without trend data, you can't tell whether a company is tightening operations or loosening them. Low working capital can signal distress rather than efficiency. A company burning through inventory to raise cash, stretching payables because it can't afford to pay suppliers on time, or watching revenue decline faster than working capital, all produce attractive-looking ratios. Without profitability filters, you can't distinguish genuine efficiency from financial stress masquerading as leanness. That's the working capital efficiency strategy, an operational quality signal backed by decades of academic research. From Sloan's accrual anomaly to the bloated balance sheet findings that followed, the SQL query is live on CetaResearch.com. You can add sector filters, adjust the efficiency threshold, and compare within industries. Link in the description. The full 25-year backtest for working capital efficiency is coming next. We tested it across multiple exchanges to see whether the accrual anomaly still holds. Subscribe so you don't miss it.